Today I'm standing by Lake Erie because I have an eerie feeling that the market's about to crash. This is a serious topic and deserves serious treatment, so tonight will not be a 5-minute video. It's going to be a tad longer. We're going in depth to answer 3 important questions. Number 1, everyone uses the term market crash, so what is really a market crash? The term has gotten overused and we're going to define it. Second, we're going to talk about, will the market crash, and if so, how far? And finally, and most importantly, how can investors prepare and handle a market crash? So let's get started. This is an intermediate level video, so if you have difficulty with some of the concepts and aren't sure how to apply it, I highly recommend you seek out an expert or a financial advisor to assist you. If you have questions or want more details, please leave something in the comments and I'll reply or do a follow-on video. Today's YouTube content creators use the word crash as a throwaway term. Oh, the market crashed again today. Well, certainly the market doesn't crash every day or even every other day. It's a rare occurrence, and a 1,000-point drop in the Dow is now 3%. Certainly not a crash. A crash event is something monumental, and you'll know it when you're in it. So how is it defined? Sharp decline in stock prices, usually sudden with no warning, rapid double-digit percentage decline. It's something over 10%. And they have euphemisms that have been discussed in the media. You may hear a re-rating, air pocket in valuations, multiple adjustment. They all refer to one form or another of a large correction. What triggers the crash, what really starts it off, is a sudden mass change in perception. The market participants at one point were bullish, and suddenly they realize something that makes them turn bearish. You can think of it like a sporting event. You've been at a sporting event where a large crowd is cheering because they think their team scored a goal. Then suddenly, a roar of sadness and disapproval comes from the crowd because all at once they all realize that the referee waved off the goal. Very similar in the stock market, where once the bids were strong and holding up prices, suddenly everyone realizes there are no more bids. The last fool has bought, and it's time for prices to plunge. And if there are no more buyers below, the plunge can be cataclysmic. That's what starts a crash. This is a chart of the daily variation in stock market prices. You see the low numbers in the center. You see the chart is skewed to the right because we've been in a bull market. This is 5 years worth of data with the COVID crash removed so as not to give us faulty answers. And the reason we're doing this is we want to see how big of a price spike is normal. Now, anytime you look at market prices, it's going to have long tails, meaning on the downside and on the upside, there are going to be values that are further out than what a standard statistical distribution would provide for. And so in this case, all we did is take a 3-time standard deviation and we got 10.37% on the SPDR's SPY symbol, which is the S&P Tracking Trust, which is one of the biggest traded ETFs in the stock market. Much like our definition that called for double digits, statistical analysis shows that a weekly change of 10% should be outside the norm on a regular basis. So we'll consider any move of 10% in the stock market in a week's time to consider to be a crash. But as we said earlier, there needs to be something to drive the crash and a change in perception. So let's take a look at some of the main driving factors that could drive a crash at this point in time. Now notice, I'm going to be arguing for a crash. I've been trading for 40 years. I could argue equally as well for a turnaround and a rally. But we're going to consider the case for the crash just so that we know, in case it happens, some of the things that may have precipitated it. A recent article from Bentley University notices that baby boomers invest too much in stocks. So the baby boomers, as you know, are older now. 30% of them have all of their assets in the stock market, and half of them have 70% or more in the stock market. So there's a lot of baby boomers who rely on the retirement for the stock market. They can't all cash in at once, but if they start to get nervous and think that a crash is impending or underway, and they all head for the exits, it will help to accelerate a crash. So it's one of the factors that we need. The second is the YouTube advice and the small investor. Program investors have been long gone. Most of the institutional investors that aren't forced to be in stocks are in defensive. They're buying crash security. They're buying treasuries. They're not buying stocks. They're not playing. And so what's the YouTube advice? What is the small investor doing? Buy the dip, right? Only now stocks are at a bargain price. So you should buy, but maybe you should just buy a little bit and then dollar cost average as prices fall. They're saying stick your toe in, buy some. We haven't learned our lesson yet. We want to get beat up some more. They're trying to buy before the market has turned around. They are trying to catch the proverbial falling knife, but only a little bit of the falling knife. Death by 1,000 cuts awaits them on the way down. These people also will eventually capitulate and decide that the market isn't for them and they need to take a break and rethink what their strategy is. At about the same time that the baby boomers are afraid of losing all their wealth and start piling in to sell their stocks, be the same time that the individual traders, the YouTube traders, all jump the train and decide that they need to get out of stocks as well. This combination of the individual trader coupled with the buying power of the baby boomers leaving the market at the same time, coupled with the other factors we're about to look at, are all the ingredients needed for a large-scale crash. So what's the big surprise? What's going to change their mind? What's going to let the crowd suddenly know that they're not playing the game that they thought they were? The surprise is the Fed wants to crash your portfolio. The Fed would like for the stock market to go down. The Fed would like money to come out of stocks. It helps them in what they're trying to do. Let's take a closer look. This is a chart of what we call an analog relationship. That's where we compare a market from history to today's market to give us a feeling of what we might be able to expect. So the blue line is the 2-year long 2000 bear market, and the rust line is where we've gone so far in the 2022 bear market. Now you can see that we're about 20% off the high, and you can see based on the previous bear market, we could have another 50% or more to drop. So that's plenty of room for us to have a crash at this point. Now the Fed may not want us to have a crash, but they'd certainly like to see valuations drop further so that people feel like they have less money to spend, because that will help bring down inflation. So let's see what else the Fed's been up to. So what has the Fed done so far? 25 basis point rise in March, rising rates to the range of 0.25 to 0.5%, and a 50 basis point rise in May, going to 0.75 to 1%. Their endpoint is 3%. They are raising rates, and that's important to us. Let's take a look at why. In 2020, when the pandemic hit the United States, and we decided that we were going to shelter and try and slow down the spread to let the hospitals keep pace, the Federal Reserve decided it was time to open up the money supply. And so this is the money supply going along here in a steady clip, and we put an unprecedented 10 trillion into the money supply. So since then, that's increased to be over 15 trillion over time. All this money was put into the system to keep the market liquid, operating, and crash-free. It worked, didn't it? So why is that a problem? That money didn't all go into the circulation. Circulating cash increased about 20% in the 2 years of the pandemic. Where that money goes is something called the System Open Market Accounts Holdings of Domestic Security. That is where the money is. And here's what it's mostly in: U.S. Treasury notes and agency mortgage-backed securities. You remember mortgage-backed securities. That was something from the financial crisis of 2009. So they put all that money into this account holding all these securities. When the Fed buys securities, the money they print goes out to pay for them. So it has the effect of putting money into the banking system, but not necessarily in the hands of individuals. All that money was put out, the Fed needs to get it back. So in addition to the interest rate increases, the Fed is going to have to get this money back. You may have heard of it as, we're going to be reducing our balance sheet. This is the balance sheet they're talking about, the $8.5 trillion balance sheet. They need to clean some of that out. How are they going to do it? This is their plan. They are going to be reducing their balance sheet starting next month. For the first 3 months, they're going to start out slow. On the Treasury securities, they're going to do $30 billion, and on the agency debt, they're going to do $17.5 billion. After the first 3 months, they double. They're going to go to $60 billion and $35 billion. So in addition to the increase in interest rates, they're going to be sucking money out of the banking system. They only have one way of controlling inflation, taking our money away so we can't spend it on things, thus driving prices down. So how are they doing? Well, GDP is still growing strong. They haven't slowed down the growth of the economy. Spending is on fire. It's growing fine. Nobody's stopped spending. Inflation's still very strong. It's come down a little bit, but nowhere near where the Fed needs it. And since spending doesn't seem to be slowing, income doesn't seem to be slowing, inflation's still strong, the Fed needs help. That's why they're coming after your stock portfolio, so you'll have less money to spend and can slow inflation down. Let's see what other factors might add to the chance for a crash. Oil prices are still rising. As you know, rising oil prices take money out of your pocket, add to the potential for a crashing economy. Supply chain is still unhealthy. The China COVID lockdown effect should take effect soon. You've been hearing about the lockdown, but you haven't been seeing shortages. That's because there's a big old line of ships between here and there. There's a 6-month delay between what happens in China and what happens here. Also, you may have heard that housing is starting to soften. So housing is another source of wealth, both from primary and secondary residences, that makes individuals feel more wealthy. So when their housing value starts to fall, they feel less wealthy. Another chance to slow down spending and ease inflation. Also, there's the old adage of sell in May and go away. In other words, seasonally, the summer is a weak time for stocks, and traditionally, that's where the saying comes from. Don't bother trading the summer, because not much good happens then anyway. So all these factors could add to the potential for a crash. So how do people determine how stocks are valued? Is the value we're at fair value? How do we decide? Well, a stock is basically a combination of earnings and psychology. In its most basic form, the value of a stock is the net present value of the future earnings. So that is the mechanical, cold, hard, light of day evaluation. There's also a matter of psychology, and psychology manifests itself in the strength of the market. Sometimes the market's extra strong and prices are high. Sometimes it's weak and prices are low. And that's true within sectors as well. You may have heard of sector rotation, which means at times technologies are strong, and then people come out of technologies and they go into consumer cyclicals. They come out of cyclicals and they go into commodities. So different sectors of the market are strong at different times. Another is popularity. You remember how exciting the meme stock era was. Lots of extra money came into the market at that time, because stocks were a popular thing to do. Now it seems crypto's a little more popular, but these things are cyclical, and so they drive the market as well. So PEs have come off their high, but how low could they go? Let's take a look at the chart and see what we think. This is a long-term chart of the S&P 500 price-earnings ratio. couple things jump off the chart whenever I look at this. First of all, before this Fed got crazy and started printing so much money, we tended to run between 20 and about 6 PEs. So somewhere here in the middle, somewhere around 12 or 13 was probably a good average. Then we had this peak and a larger peak and a similar peak to this one. Some of you may recognize this as the classic head and shoulders. And if it's a head and shoulders, the next move should be to come down here and test the neckline. So that gives us an expectation of further downside pressure. So what are some potential stopping points for a stock market drawdown at this point? We already mentioned the neckline of 13, so PE 13 is one possible spot. The other possible spot is 61.8 Fibonacci. Now, Fibonacci's used to be kind of esoteric, but most people know of them now. And because most people know of them, a lot of people are going to trade them, and it's at least going to be a resistance point on the way down. So let's see that on a chart. Okay, here's the analog chart we had before showing the neckline, okay, right here. That's at about 0.45, and the Fibonacci, and that's going to be at 382. So you see similar areas. The neckline has this nice bottom that's coincident with it, and the Fibonacci is support in this area right here. So that gives us a possible area somewhere around 40% of the gain of the 400 points that we've gained since 2008 remaining, which means since we're at 80, that gives us 40% of current market prices to lose. So that's a substantial enough area, definitely, for a sizable crash on the way. So that gives us a glimpse of what might happen in the future, but I also noticed something that may affect us in the immediate present. Some of you may be familiar with Elliott Wave theory. Elliott Wave theory says that waves tend to move in groups of 5 in the direction of a major trend. And right now, it seems the major trend is down. So whenever I notice a pattern like this of 1, 2, 1, 2, 1, 2, that's 3 groups of 1, 2s. That indicates that we will have 3 groups of 3, 4, 3, 4, 3, 4, followed by a 5. That's not necessarily predictive. Elliott Wave is better at fitting in after the action's already happened. You can put nice little labels on it and say, see, look, this is what should have happened. However, if you do notice a pattern like this and it continues to play out, that allows you to know that I should have a huge move down followed by the 4 and then the 3, 4, 3, 4, and finally the 5. And that will allow you to have a good idea when that major piece of action is over. If this 1, 2, 1, 2, 1, 2 were to continue, it's a possibility the crash could start this week. I'm not saying it's going to. Don't panic and call your broker. But it's just something to be aware of, that the 1, 2, 1, 2 setups sometimes allow you to have a feel for when a pattern is going to complete. Here at the ghbond channel, we're not satisfied with nibbling on stocks as we watch them sink into the sunset and our portfolio values slowly drain away. So how are we going to win? We're going to look at 2 cases. At first, for people who are retired. If you're one of those boomers who's retired and got most of your money in stocks, time to get out of stocks. It's been time to get out of stocks. You don't want to put yourself in a position where the stock market, which could drop as much as 80%, is going to be your main means of savings. Also, at the same time, cash is trash because your cash is being eaten away by never-ending inflation. So what do? My favorite solution right now is to move to low beta, meaning they fluctuate less than the S&P 500, high dividend, meaning they pay somewhere between 7 and 11% stocks, with a hedge. Now, what is a hedge? A hedge means that they are stocks. They don't move very much, but we really don't want to lose too much equity at all. So we hedge them. And the vehicle I like to use is something called SDS. Some of you who are a little bit older may remember the Students for a Democratic Society, if you need a mnemonic to remember it. So the SDS is a double short ETF, meaning that if the S&P 500 loses 1%, the SDS gains 2%. Now, by putting about 10% of the SDS or so in your portfolio, and you have to do the math yourself, the idea is if your portfolio of dividend stocks loses, say, 1% on the market, your SDS is going to gain and make that up. And you're going to have to do your own calculation and find out how many shares short you're going to need to make up for losses on the way down. And that's something that's going to change over time. You're going to have to monitor it every week. And if the market starts moving quickly on the way down, your amount of hedging is going to need to increase, so pay close attention to that. Gold, you can store some money in gold, less than 10%. Gold, there's also a crypto gold that you can use, and you can earn interest on that, and I'll be doing a future video on that. Land, whether it's farmland or a spot that's highly desirable, land is not necessarily something that you're trying to make a lot of money in. It is something that is a valuable commodity that should at least hold its value over time, kind of like gold. Now, if you're not retired, you're still in your building years, meaning you're building your wealth. Cash is still trash because of never-ending inflation. And you can still do dividend stocks. If you don't feel like trading and you just want to wait till this whole thing is over, then park your money in these dividend stocks, put your hedge on, and then look at it a couple times a week to make sure that when the market goes down, your hedge is doing a good job of putting that money back into your account and keeping you at or near even. And if you want to play a little bit with overbought, oversold, you can even experiment a little with going a little extra high on your hedge or extra low on your hedge based on overbought, oversold indicators. And that's the SDS we would use. Or if you are heavy into tech stocks, and I know the S&P has a lot of tech stocks, but you can do a comparison on your portfolio or perhaps divide your portfolio into two sections, and you can hedge with the SQQQ on your more technology QQQ correlated stocks. Now SQQ is a triple versus the SDS, which is a double inverse. And again, you have to do the calculations to figure out how much SQQ you need to offset down moves in your stocks. And it's not going to be exact. You just want to keep your portfolio. If the market's down 40%, you don't want your portfolio to lose more than 5%. That's what we're looking for. Material stocks in swing trades, and the reason I say that is because oil goes great, copper goes great, wheat may go great. A lot of these materials and commodities may go great, but you have to swing in and out of them because they have been having wide swings. If you don't have skills in swing trading, that's probably not for you. Early startups with a clear path to profit. If you're in a startup early enough where it's about to become profitable, it doesn't really care what the market's doing. The market fluctuations don't really affect you, so that's an opportunity to still be in something that has big opportunity for gain even in a bear market. And I've been reporting on one such stock. It's in the penny range. It's RMSL. I started reporting on it at about 2.4 cents, I think, and it's just under 4 cents now, so it's getting close to putting in a double. It's waiting for an FDA approval, and then we should have further profits. Also, put options for traders. The advantage of a put is if we get a crash, not only do you gain on the put, and your price will go up, but also because your volatility will go up dramatically, you'll get a double win on that. That's a little bit tricky, and option strategies are definitely beyond the scope of this video. This video has pretty much taken me to my limit of doing a video in one night. And so at this point, we're going to bring it to a close. And again, put anything in the comments if you need more information on things, want me to do a follow-on video, or you have questions. Be happy to answer them. And I hope this helped you understand the causes that may cause us to go into a crash, and also how you protect yourself and plan to win. At the GH Bond channel, we always want our portfolio to be going up in value no matter what the market's doing. So until next time, this is GH Bond signing off. Got to finish editing this thing and get it out so you people have a chance to look at it Monday morning.